Let's talk about money, but not in the way you're used to. Think of finance as its own special language. And like any language, once you learn a few keywords and phrases, you start to see the world in a completely new way. So, let's crack the code.
You ever listen to the financial news and just your eyes glaze over? It feels like they're speaking in riddles, right? Dropping all this jargon that just sounds designed to be confusing? Well, you're not wrong.
And look, this isn't just annoying, it's a real problem. This language is used in rooms where huge decisions are made about our economy, and it's designed to keep most of us out. But here's the thing, you can learn to speak it. And you should. It's how we all get a say in how our world works.
To really get what's going on today, we have to rewind the clock. We need to look at the big ideas that were running the show before the 2008 financial crisis. Because these weren't just theories in a textbook. They had massive, real-world consequences.
Okay, so the main philosophy back then was something called neoliberalism. It's a big word, but the idea is simple. Just let the market do its thing. Less government, less regulation, and a core belief that markets would always sort themselves out for the best. This became the playbook for decades.
And going hand in hand with that was the efficient market theory. This was basically gospel on Wall Street and in Washington. It says that the price of anything, a stock, a house, is always correct because it reflects all the information out there. So if you believe that, how could a bubble ever happen? It seemed impossible.
But here's where the theory just smashed into reality. The theory said everyone was rational. But in the real world, you had what's called momentum trading. People would buy a stock just because it was going up. That's herd behavior. It's not rational, and the theory had absolutely no answer for it.
So, with those ideas as the backdrop, let's look at the actual machine that was built. How did that philosophy translate into the nuts and bolts, the financial products that drove the world to the brink?
It all started with this process called securitization. Think of it like a factory assembly line. A bank makes a loan, then they take that loan, bundle it with thousands of others, chop it up, and sell the pieces to investors all over the world. It turned a slow, boring mortgage into a fast-moving product.
So here's the fatal flaw. If you're a bank and you know you can sell off a mortgage the second you make it, do you really care if the person can pay it back? Nope. The risk is now someone else's problem. On top of that, these bundles were so complicated, nobody who was buying them had any clue what was actually inside.
Then, as if that wasn't risky enough, they added another layer of complexity: derivatives. The easiest way to think about these are as side bets. A derivative gets its value from something else, like those mortgage bundles. A famous one was the credit default swap, basically an insurance policy on whether those mortgages would fail.
And this is where it all became a giant house of cards. The market for these side bets absolutely exploded. Pretty soon, the total value of all the bets on the mortgages was many, many times bigger than the value of the actual mortgages themselves. The whole system was balanced on a pinhead.
So when this incredibly fragile system finally came crashing down, who got stuck with the bill? This gets us to a really important idea about who gets the rewards and who takes the risks.
Just look at this chart. It shows how much of their own skin the banks had in the game. And the answer was almost none. Major banks had equity ratios below 3%. That means for every $1 of their own money, they were gambling with more than $30 of other people's money. It was insane.
This quote nails the central problem, which has a name: moral hazard. It's a heads-I win, tails-you-lose situation. When the bets paid off, the bankers and shareholders made fortunes. But when the bets went bad, well, their own losses were limited.
So what happened when those losses became real? The government, meaning the taxpayers, had to step in with massive bailouts to stop the entire global economy from collapsing. Profits had been private, but the losses became everybody's problem.
All right, so after that meltdown, the financial world had to change. And the economy we live in today is shaped by a whole new set of tools and a new set of challenges that were born from that crisis.
One of the big things now is the shadow banking system. It's exactly what it sounds like. These are firms that act like banks, lending money and creating credit, but they operate in the shadows, outside the normal rules and regulations. This makes it really hard to see where the next big risk is building up.
And then there's the big one, QE, or quantitative easing. This is where things get kind of wild. Central banks literally create new money out of thin air to pump into the economy. The goal is to keep things moving, but the massive, looming question is always, what happens when all that new money leads to inflation?
And of course, you can't talk about money today without mentioning crypto. Things like Bitcoin are a whole new beast. They're created by code, not by governments. Their value is based entirely on what people believe they're worth, which is exactly why their prices can swing so dramatically.
So let's just pull this all together. What are the big takeaways? First, those abstract ideas really matter. They shape everything. Second, shiny new financial products can hide huge, system-destroying risks. Third, this problem of moral hazard, privatizing profits and socializing losses, is still a central fight. And finally, the game has changed, with new tools like QE and new players like shadow banks and crypto defining the world we live in now.
Look, learning this language isn't just a mental exercise. It's about empowerment. It gives you the tools to understand what's really going on, to ask tougher questions, and to demand better answers. So now that you can speak the language, how are you going to use your voice?